Welcome back to the Investing on the Go podcast, brought to you by FundCalibre. UK smaller companies have had a tough run, but signs of a turning point may be emerging. In this episode, we explore the recent market dynamics, investor sentiment, and why the long-neglected UK small cap space could be poised for renewed interest and better performance in the months ahead.
So I'm James Yardley, and today I'm joined by Scott McKenzie, Fund Manager at the Amati UK Smaller Companies Fund. Hello, Scott. Thanks very much for joining us today.
Thank you for having me, James.
Now, Scott, it's been an incredibly challenging period for UK smaller companies. I can't remember a period in my career where we've had such a tough time. But are we finally at the point where we're turning a corner? We've seen 7 years of underperformance, I think, in UK equities. What's changed recently to make you feel a bit more optimistic for the sector?
Well, thank you for the reminder there, James. 7 years is quite a long time, isn't it? From where we sit, with our UK smaller cap, bias, it's certainly been possibly 3-4 years now, where we've really felt the pressure from the strategy and from the lack of love in the asset class. I think there are some early signs of a turnaround, and the recent events with the Liberation Day and the Trump tariffs, I think that possibly has marked a turning point for what we do in the UK. And I think there's now potentially a better and wider audience for UK equities in general and for small caps in particular. So we've now begun to see our own fund and small caps in general perform somewhat better than they have done. Just it's early days. We've only had maybe 3-4 months of better numbers from the fund, but nonetheless, there's some early signs of better times ahead.
Yes, and April was a very volatile month for equities globally. Of course, we had Trump's tariffs and came in, and markets have moved all over the place. But UK small caps have actually held up reasonably well, I think, and have bounced back quite strongly. Can you talk us through why the fund outperformed in that period? And hopefully, is this the start of something bigger over the next months and years to come?
Yeah, it certainly felt like a bit of a turning point. As you say, April was an extraordinarily volatile month, one of the most volatile months any of us can remember in living memory. And I think what was encouraging was that our asset class, finally began to, get itself ahead of the global indices. Obviously, the US markets were particularly badly affected in the early part of that month. So small cap was actually one of the better performing asset classes, during April. And I think you get to the point where, we will perhaps come on and expand on this topic, but we feel as though, the selling, will dry up at some point, and there's now, a lot more interest in the asset class, and to buy in small cap is relatively difficult. And we've always said for a while now that it will not take much to turn the market for UK equities and for UK small cap in particular around. And I think we're now beginning to see some early signs of demand being greater than supply.
Are you starting to see some of those flows come in from institutional investors or some of the bigger investors, maybe some of the pension funds and things? I know that there's been a focus from this government on trying to get pension funds to invest more in the UK. I think most of that focus has probably been on the private space, but are you seeing a little bit at the margin coming into in the public equity markets?
In a general sense, we're not quite seeing it yet, and certainly from where we sit at Amati, we're not yet seeing the evidence of money coming in. At this moment in time, we just want to see a situation where things stabilise and where we don't see outflows. And clearly, outflows have been an enormous challenge for all UK funds, in particular small cap, and we've not been immune from that. Just in the early part of this year, we were still seeing challenges in terms of outflows. Touch wood, that has now dissipated, and hopefully we're on a much firmer footing than we were a couple of months ago. You made reference to pension funds there. That there has been a lot of talk about things such as the Mansion House Accord, which is pledging more support for UK assets. That won't necessarily touch public markets immediately. The kind of focus of that is predominantly, private assets to begin with. But interestingly enough, it does include AIM within that definition, which something we could perhaps come back to in a moment. And, AIM has obviously been a particularly challenged part of the UK small cap market. So there is some hope that, there will be a modest benefit, to AIM from those types of accords. And we are seeing, some early evidence that one or two local authority pension funds are now upping their allocation, to UK listed companies as well. So it kind of feels as though we may have turned a corner, but it's still early days.
And with all the ongoing talk around tariffs, I mean, is that good news for UK small caps, or is it still present challenges for some of your businesses as well? I mean, is this a moment for UK investors to maybe think about reallocating some of the money perhaps which has gone overseas in recent years and bring some of that back home?
I think what happened in April was definitely a wake-up call for investors in general. We've had a long period of US dominance in the global markets, and that's been the market to be in for a number of years now. And I think what the tariff kind of uncertainty has brought is some reappraisal of that dominance. This what they call US exceptionalism now feels as though that's been, you have to at least challenge that. And I think, therefore, relatively speaking, the UK markets are quite well placed, and particularly small cap. The small cap index tends to be more exposed to the domestic economy. And what we've seen, with regard to, the tariffs, are strengthening in sterling. And that's generally good for, importers, domestic sectors, such as retail, for example. They're a beneficiary of stronger sterling. And I think there's just, in general, a reappraisal going on between where people allocate their money on a global basis. And even if we take a very tiny scrap from the table there, it's still a meaningful amount, for UK investors. So I would hope that we're now seeing the beginnings of a reappraisal, in terms of asset allocation.
And the AIM market, as you mentioned, I mean, it's had its fair share of challenges in recent years. There's been a fair bit of uncertainty on the inheritance tax benefits there and things, and the government's been changing the rules on that. And where are we now with the outlook for AIM? I mean, is it now a much better index than it was in the past? Has it been refocused? Are there lots of good, high-quality companies there for you? I mean, how do you feel about it?
You're right that it's been an extremely challenged part of the market, and that remains the case. It's an index and an element of the UK stock market that does need some reform. We haven't seen enough exciting companies join the AIM market, and if anything, we've been losing companies, predominantly to takeovers. So there's no silver bullet for AIM as we speak. Your point about quality companies is well made. There are still lots of companies that we can invest in AIM, and we're really pleased to do that. So one thing that we haven't done in the fund is run away from AIM. If anything, we've kind of ran into the fire, and we've increased our exposure to AIM, if anything, within the Amati UK listed smaller companies fund. And we currently have almost half of the fund in AIM listed securities. So we really have, if anything, increased our exposure to AIM. It's always been a major part of what we do at Amati, and I think now is the time to actually embrace it rather than run for the exits. But we can't deny that the market for AIM listed shares is shrinking. I mentioned takeovers a moment ago. That's an ongoing feature within AIM in terms of companies being bid for. So we have to be mindful of that, and there certainly aren't enough new companies coming to the market. Interestingly enough, though, we have seen some fundraisings in AIM, a couple of very notable ones in the past 6-9 months. We were fortunate enough within our fund to participate in the placing Greatland Gold, which was kind of towards the end of last year, and that's been a really, really successful investment for us. So we've ridden the crest of that wave in the gold price very well, and that company's more than trebled in value since it raised its money in AIM last year. And more recently, we've had a very significant fundraising from a company called Rosebank, which has just literally raised £1 billion in AIM. So a pretty material amount of new equity going into AIM for what is effectively a shell company run by the managers of a business called Melrose, which has been a very successful listed company in London over the past 20 years. So there is an appetite for really good fundraisings in AIM. Those two being very good examples. We're just not seeing enough of them, and we're certainly not seeing IPOs. We've only really had one of any note in the current year, and that's MHA accountancy business. So the challenges remain, absolutely, but we can also find some great businesses within that market, and if anything, we're doubling down on it.
I mean, that's very interesting. I mean, and where are we on valuations in UK small caps? We keep hearing that they're cheap, but they seem to have been cheap for a very long time. I mean, whenever I look up a company, I am surprised at how small some of the market caps are relative to what are quite serious big businesses, with tens of millions in revenue. But maybe I don't understand. I mean, obviously don't look at them like you, but are they as cheap as people say? I mean, or do we actually need to see kind of that cyclical upturn and for some better earnings as well before we really get some good performance?
Yeah, I mean, this is something we've really been banging on about for quite some time, and you feel almost like a stuck record, really, in terms of the valuation metrics. And myself and the rest of the team, we've been really running small company funds for many, many years, and it's difficult to remember a time where they've been so out of favour. And when we look at the valuation of our own portfolio, although the portfolio has gone up in value over the past year, the valuation metrics haven't changed at all. They're still extraordinarily low compared to our historical analysis. And whatever metrics you choose, whether it's good old-fashioned PE ratios or cash flow yields, or price to book, they're all at very depressed levels. So valuation isn't really the problem here, but it does tell a story of undervaluation of UK assets, both compared to overseas markets, the US in particular, and also relative to private assets. So when we look at comparable companies in the private markets, they tend to be at much higher valuations than those in the public markets. For example, wealth management is a sector which I'm sure most of your listeners will know quite well, and the quoted companies are generally trading at very depressed values, whereas some of the private businesses are kind of realising much better valuations. So that suggests to us there's something, there's a structural undervaluation of UK listed companies. And to be honest, for us, that is an opportunity. It shouldn't be a threat. It should be a fantastic opportunity to buy great businesses at bargain prices. And that's really what we're trying to do with the fund.
Very good. And in terms of the flows, though, I mean, that is, I think, been one of the big problems is the UK retail funds keep shrinking. I mean, what are you seeing on that front? I mean, is there any reason that those flows are potentially going to turn around? I mean, we touched on it before that maybe people might bring back some of their allocation from the US and things. I mean, what are you seeing there? I mean, and do we need those flows to come for the asset class to really start performing again?
Well, I think the flows that you refer to are predominantly in the retail funds arena. And there's a lot of good data comes out on a monthly basis on this. Carlstone, do a particularly well followed series here, and that's a fairly gloomy and depressing series, and has been for 3 or 4 years now. That has remained the case in the current year. Interestingly enough, the month that we just had, April, those outflows have begun to moderate a little bit, but they're still not positive. So we have to acknowledge that. I mean, you made reference to the pension funds a moment ago, and they could dwarf anything that would happen in the retail funds world. So we kind of take the view that most of the retail fund selling has to be over by now, and it won't take a great deal to turn the ship around. There's no immediate evidence yet of that happening, but certainly one also has to consider the impact of non-UK investors. What we are seeing both anecdotally and in the markets are real evidence of US and European investors buying UK assets. So that is definitely one of the reasons why we think the sentiment towards the UK has improved, because overseas asset allocators are now buying the UK. And we see that in things like the Bank of America survey, which, for a long, long time has been extraordinarily negative about UK equities. And in March, for the first time ever, it turned quite positive. So that tells me that there is a lot of global interest now in the UK stock market. Even if our retail investors aren't quite there yet, there are other investor groups who are definitely, all over this. And the other part to that story, I think, is the increase in takeover activity. We've seen a lot of takeover activity in recent months in sectors, such as technology, companies such as Alpha Wave, Alpha International Group, which we own in the fund. That's currently in discussions with a private equity business. Just the other day, we did a bid for Spectrus, the engineering company, and that was the shares went up almost 60%. So there's considerable interest, from private equity and non-UK investors in the UK stock market. So we don't necessarily need the retail investors to return with a vengeance. I think there's a combination of factors which can turn the market around.
So Scott, to kind of summarise then, what is your outlook for the next 12 months? Are there any sectors or themes which you're particularly excited on, and what should investors look out for?
I think we're pretty excited in general about the prospects for the portfolio now. And you investors in smaller companies have been through quite a lot in recent years, including our own investors. We're definitely not satisfied with how things have gone, for the fund in the last 3 or 4 years. But, for the first time in a long time, we feel genuinely excited about the prospects for great returns across the portfolio. And we made reference earlier to things such as AIM. We remain massively committed to AIM. It's 50% of the fund, and we can see considerable upside in a lot of the holdings that we're invested in there. So that's something that we're excited about in a broader sense. And there are just no shortage of new things and new ideas that we can bring into the fund. And that tells us that the markets are still very, very keenly valued. When you've got lots of new ideas, that's generally a good sign. We tend not to run the fund on a sector or top-down basis. So we're very much bottom-up stock pickers. But just to give you a flavour of some of the things which are now making a difference to us, sectors such as the gold sector. I mentioned Greatland Gold a moment ago. That's been a really super investment for us, a real success story in a short period of time. Again, an AIM-listed company, so that's been really pleasing. We've also built up our exposure to the defence sector, which in the current environment feels like a good place to be. We're now seeing, obviously, defence budgets being reallocated across Europe and indeed increased. So that's a segment, again, where we see good prospects, and we're already seeing good returns. But over the piece, the combination of the valuation and the liquidity, when it improves, we think mean that we're at the early stages of a really strong market cycle for UK small cap. So definitely feeling much more positive than we have been for some time.
That's brilliant, Scott. Thank you very much for all those insights. That's been absolutely fascinating.
Thank you, James.
An unconstrained portfolio seeking structural UK growth businesses that can grow faster than the economy, WS Amati UK listed smaller companies fund is managed by a highly experienced team of small cap specialists. The portfolio of 65 to 70 companies focuses on structural growth businesses, which the managers believe can add value in the under-researched small and mid-cap part of the market. To learn more about the WS Amati UK listed smaller companies fund, please visit FundCalibre.com, and don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts. Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.